I can only get to 7,000 on gold and 200 on silver, but it won't surprise me if those numbers prove conservative. Pretty confident with the 200. I just can't get to the 3, 4, 500s that Michael's talked about, and certainly not 1,000. I do think the metals will, as they always do, get hit in a big market correction, in a recession, or in this case, is a bigger than recession type downturn.
How much of the gold story do you think is a currency debasement story?
Finally got to max pain, max bearishness, and obviously what Besant did today, announced today, helps. But
how much trouble is Japan in right now? Because we just saw the US essentially intervene in the yen market.
We don't really know what's going to trigger the bust, but now it's breaking out, and so will rates. Rates track inflation, and that's their problem. Is for decades they maintain this policy. 330 trillion plus in global debt out there. Certainly China's a big part of that. Certainly the US is part of that. Japan's part of that.
Where would you be looking to invest today? You mentioned silver. There's only about 4 people on this show who've mentioned $1,000 silver that come to mind: Michael Oliver, Lynette Zhang, Francis Hunt, and yourself. Michael Oliver was very bold with his call. He believes silver could go to 1,000 within 1 year. He didn't call for that. He said it wouldn't shock him. So I just want to clarify that for people who are piling on and saying this guy's crazy. He said it wouldn't shock him, but he has pretty high targets. Could you unpack that a little bit for us? You said you think it's going to go to 200 this cycle, eventually correct in the bust, and then rise again, potentially up to 1,000. Is that correct?
Yep. Yeah, I can't get there myself to Michael's numbers, but I don't think he's crazy, and I certainly don't discount his experience and knowledge. And it's certainly possible it exceeds my expectations for this cycle, but right now 200 is as high as I can get, and I raised it. I had it at 125. I think going into January, and then raised it to 170, I think, and then raised it again to 200 at the end of May. So, but that's, I'm pretty confident with the 200. I just can't get to the 3, 4, 500s that Michael's talked about, and certainly not 1,000. The 1,000 for me is probably a 2032 or 3 type period, but you can drive a truck through how much you can miss that by.
Silver reaching $200 sounds extreme today. But the more important question is why investors keep underestimating what happens after a monetary reset. David Hunter notes that $200 is his current ceiling, while $1,000 belongs to a later cycle, meaning the real opportunity may not be the headline target, but the sequence getting there. Markets repeatedly punish investors who demand certainty before buying. If silver reprices violently, waiting for confirmation could mean paying multiples more. Next, David Hunter exposes why the biggest gains may arrive only after the first bust.
It could be 2 years either way, but if it's the next cycle really getting driven, and it comes from a lower level in the bust, I do think the metals will, as they always do, get hit in a big market correction, in a recession, or in this case, is a bigger than recession type downturn. But those that are very turned off by the fact that silver got to 122 and rolled over and has been down for months, and it shook out a lot of weaker hands. As you know, because we've talked about this for years, I was bullish on silver and gold 2, 3, 4 years ago, and it took a while to get going. Gold got going before silver, but silver, I took a lot of heat because when it was in the mid 20s and just couldn't get out of its own way. It was trade, and particularly in miners, but between mid 20s and the high teens, and then it got up to 30 and then backed off again. People just didn't believe that it had the kind of legs that I talked about. And then when it finally broke out and took off, that's when people jumped on the bandwagon. So they didn't buy it at 30 or 40. They bought it at 60, 70, 80. And then they're really upset because they lost money. But that's markets. Once things get too ebullient, the market has a way of basically bringing back the discipline, shaking out the weak hands, And because the run from 50 to 122 was parabolic and happened so dramatically, it took months to correct. And I can say that looking back, I didn't know that it was going to take 6 or 8 months to get going.
The most dangerous moment in a silver bull market may be when investors finally decide the story is over. According to David Hunter, the plunge from 122 was not proof that silver had failed. It was the kind of violent reset that can remove weak hands after a parabolic advance. The uncomfortable lesson is that retail often waits for certainty, then buys after the explosive move has already happened. That mistake can turn volatility into permanent opportunity loss. Next, David Hunter reveals why the correction itself may have been the signal.
But I'm confident now that that 55.6 level was the correction bottom, and that we have begun the turn. Obviously, today it's coming out of a little bit of a pullback yesterday, and it looks like it can go higher. There's still going to be pullbacks. It's still going to be, you have to be careful with it. But I do think once it breaks above a certain level, and I'm not sure whether that's, I see 72 right now as the next stop, but I know Michael's probably talking higher than that. But there'll be corrections along the way, but I don't think they're going to be long lasting. They might last days, but not months.
Yeah, and it's interesting to point out that back when silver was range bound between around that $20 to $30 level, people would call you crazy for saying silver would get to $50, let alone 100, let alone
Right.
120. So people who are upset about the silver price today, I mean, what do you want? We're at $65 here. Tell somebody, the beginning of last year, silver is going to 65. They would have said, you're either lying or, it's life changing. But now everybody's crying. So I think that's funny. Gold. How much of the gold story do you think is a currency debasement story? And how much of the broad market rising do you think is a currency debasement story? Because obviously the extreme example we could look at is in hyperinflationary environments such as Zimbabwe. I forget what year that was. The stock market went absolutely ballistic. I believe Weimar Republic in Germany stock market goes ballistic because of the currency depreciation at such a rapid scale. Do you think currency debasement is behind the rise in gold and the broad stock market as well to some extent? And if so, how much?
Yeah, for sure.
The market can look broken right before momentum quietly returns, and that is where investors usually misread the evidence. What David Hunter is highlighting is the shift from months-long corrections toward potentially shorter pullbacks, with 72 lalons becoming an important near-term threshold. Silver being around 65 lalons also shows how quickly yesterday's impossible target becomes today's starting point. The danger is assuming another decline means the thesis failed when volatility may simply be repricing risk. Next, David Hunter exposes the currency signal hiding underneath gold's broader rally.
Sure, it plays a role. I mean, if you price gold in various currencies, you'll see differences in returns because currency matters. Um, Obviously, the dollar in the last year has been up, and yet gold had a nice run. So it hasn't been the case near term, but I do think the big move from 4,500, 44,500 here to 7,000, a lot of that is going to be currency. I mean, the dollar, I have the dollar going to 83, something like that, over the course of the next 6 or 9 months or less. And if that happens, it's a big part of the move to 7,000, I think. It's more than that, though. Obviously, rates coming down, which, as I said, I think rates peaked yesterday. And I don't usually try to call things to the day, and I didn't call it, but I mean, I don't usually pinpoint things like that. But it looks to me like you finally got to max pain, max bearishness, and then obviously what Besant did today, announced today, helps. But I have rates going down from here for the next 18 months. It'll start gradually, but ultimately, like I said, you could get 10-year down to zero. And that first move down, let's say from, the 460, 70 area down below four, I think is going to help gold. That'll be trading down well. The rates will be trading down well. while gold's moving up and silver's moving up. And then I think you can get a faster move from there down to 3 or even below. That will be kind of that final move up towards those numbers. And I
Gold's next major move may have less to do with gold itself than with the currency underneath every quoted price. This is where David Hunter's thesis shifts toward a falling dollar, declining yields, and a potential 10-year treasury rate approaching zero. That creates a strange setup. Rates fall while monetary assets rise, challenging the assumption that gold needs a strong economy to perform. For savers, currency depreciation can quietly erode purchasing power even when nominal portfolios rise. Next, David Hunter unravels why Japan could become the market's wildcard.
How much trouble is Japan in right now? Because we just saw the US essentially intervene in the yen market. A lot of people talking about this was to stop Japan from selling off a bunch of its treasuries, considering it's in a pretty precarious situation right now. It's a net oil importer. I think it imports the vast majority of its hydrocarbons, and it gets a lot of those, I believe most of them from the Middle East. So it's been hit a little bit hard, although I believe they have made some deals with Iran to get some oil through the strait. And then, of course, the yen dropping and Japanese bond yields rising to very high levels historically. How much trouble are they in? And if things really go wrong there, could it reverberate throughout the global economy as well?
Yeah, I have said they are kind of the wild card in the bust. We don't really know what's going to trigger the bust or what's going to be the most dramatic piece of the bust, but certainly Japan is right up there as a candidate. I mean, they have maintained zero interest rate policy forever and have basically kind of looked like you had made monetary theory extinct. That you could print money forever and not have inflation. And I'm a monetarist pretty much, and I just think what we're seeing now is what should have been expected. Is that at some point, yes, they are more homogeneous society, and they had lots of things that they could kind of that help them keep inflation in check for a while.
Japan's greatest risk may not be its debt level alone, but what happens when decades of cheap money finally stop working? David Hunter's argument suggests Japan could become a trigger for a broader market shock because its long-running monetary experiment depended on suppressing borrowing costs. If yields continue rising, the adjustment could reach currencies, bonds, and global portfolios simultaneously. Investors treating Japanese policy as a distant problem may discover that interconnected markets have no safe distance. Next, David Hunter reveals why leverage can reverse faster than confidence.
But now it's breaking out, and so will rates. Rates track inflation, and that's their problem. Is they've for decades they maintained this policy and thought they could get away with it. Well, guess what? Now it's you you postpone the monetary response, but or the response to the monetary, but it's coming now. And I think during the next year, you will see rates keep pushing up there. Um, and they just don't have, I don't think they have the leeway to deal with that. And I mean, I have the yen going, and I do yen dollar, not dollar yen, but the yen to the dollar I have going to 0.0085, and it's down around 0.0063 something, 635, say. So I have the yen going pretty high here over the course of the next 6, 8 months. And the dollar obviously is going to be down against the euro, the yen, even the other dollars, Canadian dollar and the Aussie dollar, et cetera. So, but I do think that in the bust, Japan's going to be probably one of the places where it's just over leveraged, very over leveraged to that policy. And as I have preached over and over, leverage works both ways. On the way up, it enhances returns. We're seeing that here in our markets, in our in everything we do. And leverage decimates you, as we found out in 2008-9. on the other side.
Japan's currency problem becomes far more dangerous when rising inflation forces markets to challenge decades of artificially cheap capital. According to David Hunter, rates could keep climbing while the yen strengthens, creating pressure that policymakers may struggle to absorb. The deeper issue is leverage. It magnifies gains during expansion, but accelerates damage when conditions reverse. That means seemingly modest changes in yields can produce disproportionate losses across leveraged portfolios. Next, David Hunter exposes where this leverage could collide with global debt.
So that's basically my reason for having a bust is we've got 330 trillion plus in global debt out there. And, certainly China's a big part of that. Certainly the US is part of that. Japan's part of that. All Western countries are part of that. I'm not calling for a sovereign crisis because they have the printing press, but there's a lot of private debt out there that I think is going to have a problem. Certainly commercial real estate. We'll find out there's another shoe to drop there. Private equity, private credit, etc. There's plenty of candidates where once this thing rolls over, once something triggers, you're going to see an awful lot of things show up.
And given everything we've discussed so far, where would you be looking in the market today for potential opportunity? Because obviously we're in a very uncertain market environment. You believe that the broad market's going to continue rising. That could be difficult to time for your regular average retail investor who doesn't know how to look at charts and doesn't understand a lot of the macro behind it. That's the issue we've come to in today's investing world, is this passive investing, as you were speaking of. People now believe that the stock market is a high interest savings account, that you put money in it and then you just wait, and over time you're just going to keep making more and more money. And I think that I agree with you that paradigm is rapidly changing.
A $330 trillion debt mountain does not need a sovereign default to create serious damage. Private borrowers can become the fault line first. What David Hunter's argument suggests is that commercial real estate, private credit, and private equity could expose hidden fragility once liquidity tightens. The passive investing narrative becomes dangerous when investors mistake rising indexes for guaranteed savings returns. A portfolio built for permanent expansion can behave very differently when leverage starts unwinding. Next, David Hunter reveals why the timing of the bust matters more than the headline debt number.
So with all that in mind, where would you be looking to invest today? I know you mentioned long-dated U.S. Treasuries before. Is that an area you're bullish on, and anywhere else where you're seeing potential value?
Yeah, so it's a little tricky, and people jump ahead because I do have my 0% Treasury call, but it starts very slow. So there's a period in here, and again, everybody has to figure this out for themselves based on their own experience and risk tolerance, etc. But we're in a funny place where, I have a 90 number for XLF, the financial ETF, and I'm not sure where that is now, but that's more than a 50% move from here, I think. And so there are still, when you figure the numbers, there's 2 and 3 year returns still ahead of us that are going to happen in a matter of months. So you have to look at both time and what the upside is. And so I just caution people, even though, and again, some people should probably, because I could be wrong. Lots of the call could be wrong. So you have to understand the risk we're at when we're this late in the game. However, if I'm right, and there's 30, 40, 50% returns left in some of these areas, you run the risk that you jump out now and say, I'm just not smart enough to time the top and I'm nervous.
The strangest market setup is one where the biggest risk and the biggest remaining gains can exist simultaneously. This is where David Hunter's thesis shifts. He sees potentially substantial upside in financials while also preparing for a future treasury rally as rates eventually collapse. That creates a timing dilemma rather than a simple bullish or bearish choice. Investors who exit too early may miss the final surge, while those who stay blindly risk the reversal. Next, David Hunter exposes the psychological trap that keeps investors buying at the worst moment.
As you've been nervous since 2020, a lot of these people have been nervous all along, particularly institutions. But if you jump out now, you run the risk that if you get this final parabolic run, it's gonna, psychology being what it is, it will suck you back in for a lot of people, and they'll end up getting out, understanding what's coming, but then getting sucked in by the fact that, hey, how do I know this is the top? I was wrong. I missed on 30, 40, 50% returns, and people are telling me there's 2 and 3 years to go on this. I got to get back in, and then you get back in at the top. So I just caution people. And again, it's not advice. Everybody has to kind of figure out for themselves. But just know if you decide you're getting out early, don't get swept up into the emotion of it. Secondly, and treasuries will be, I think, at the top of the list of things that will protect you in the bust. There are very few things that aren't going to go down, and treasuries, I think, are going to be one. And that's both from the very short end all the way out. If in fact rates are falling during the bust, as they should, the long duration is where you're going to make the most money. But it's also the place where, if I'm wrong, you're going to have more volatility. So
the market's most expensive mistake may be selling too early, then buying back because everyone else looks richer. This is where David Hunter's thesis shifts from price forecasts to investor psychology. A final parabolic run could lure cautious investors back near the top. Meanwhile, treasuries could become defensive winners if rates collapse during the bust, creating a sharp contrast between perceived safety today and actual protection tomorrow.